happens when a continent stakes its entire economic credibility on a war it cannot afford to lose. Alright guys, things are clearly spiraling. Russia is not just posturing anymore. They are actively going after their money, and this is the point where it becomes obvious that nothing is going back to how it was before. This is not a temporary shock. This is a permanent shift. Before we go further, do me a quick favor. If you want calm, no-nonsense breakdowns of power, money, and the real forces reshaping the world, hit subscribe right now and stay with me through this one. You are going to need the full picture to understand what comes next. Now let us slow this down and unpack what is really happening. For the European Union, a Russian victory is not an option. Not politically, not economically, not psychologically. The current US proposal essentially looks like a concession to Russia, and that is exactly the problem. If Russia walks away looking like it won, the entire European structure starts to wobble. Think about the question every European leader would be forced to answer. Did we shut down our own industries, absorb energy shocks, spend close to $200 billion and still lose? That is not just embarrassing. That is destabilizing. That kind of outcome forces every member state to rethink why they are even aligned in the first place. This is why asset confiscation is not really about punishing Russia. It is about survival. The EU as a bloc may not withstand a clear defeat. The economy would already be under extreme strain, and politically, the unity would fracture. That is the real driver here. Viktor Orbán understands how fragile this situation is. His position is simple. If defeat is already baked in, then dragging it out by playing games with frozen money only deepens the damage. At that point, prolonging the conflict becomes self-sabotage. Now, let us talk about what can go wrong, because this is where the long-term damage really sets in. Once the EU touches those assets, the European financial system becomes permanently suspect. Trust is everything in finance, and once it is cracked, it does not come back easily. Countries like China will think twice before parking capital there. No one wants their money sitting inside Euroclear or any European institution, knowing it can be seized under political pressure. That means fewer buyers for EU bonds, less deal flow, less foreign investment. Even buying stakes in European companies becomes risky because physical presence inside the bloc no longer guarantees safety. If assets can be seized once, they can be seized again. From Russia's perspective, the damage has already been absorbed. The Russian central bank has issued a clear warning. Compensation will not just be symbolic. Russian courts will be used, and EU banks are very much in the crosshairs. Vladimir Putin wants the full amount, all $230 billion. That signals something important. Any EU assets still operating inside Russia are now exposed. Financial institutions come first, and it expands from there. Belgium is especially nervous because that is where most of the frozen funds sit. Brussels is still scrambling to find ways to use the money, but Moscow is not bluffing. The EU cannot afford a Russian victory, yet every move to prevent it increases their own risk. Will Russia recover the full $200 billion? Probably not. But a large-scale extraction is absolutely on the table. Only a handful of European banks still have exposure. Austria's Raiffeisen and Italy's UniCredit are the big names. And the precedent is already set. A Russian court has ordered Raiffeisen to pay $400 billion in compensation linked to sanctions. That opens the door wide. Loans given by EU banks to Russian entities are still out there as well. Those can be seized. That is leverage. There has been speculation about Russia targeting EU assets in China using Chinese courts. I do not see that happening. It would put Beijing in an impossible position and damage the Chinese financial system itself. That would hurt Russia-China relations more than it helps. It is an option on paper, but not a realistic one. The real damage comes from something else entirely. As EU banks exit Russia, Chinese institutions move in. This is the quiet shift no one in Brussels wants to talk about. The Russian and Chinese financial systems are becoming deeply intertwined. Here is why that matters. Russia currently runs a rare trade surplus with Beijing. They sell more to China than they buy. That surplus used to be held in euros and dollars, which is why Western banks had such a strong presence before. Today, it is mostly held in RMB. Russian firms now need places to invest that surplus. Chinese banks are the obvious solution, not just for loans, but for absorbing Russian capital outright. Over 99% of bilateral trade is now done in local currencies. When the war eventually ends, look at who will still be standing. Chinese banks. The metals trade shows this clearly. Copper exports to China are up 66%. Nickel imports have more than doubled. That kind of trade requires financing. Chinese banks also still hold large dollar and euro reserves, meaning they can finance Western trade even after the war ends. So when Russian earnings come home, where do they go? Not into EU bonds. They go into Russian and Chinese banks. Chinese bonds get bought instead. This is the deeper cost of asset seizure. Yes, it scares investors away from Western assets. But underneath that, it rewires the financial plumbing of the global system. EU banks are slowly disappearing from relevance in this corridor. And at the same time, Europe has dug itself deeper. Ukraine now needs even more support. The EU just approved 90 billion euros after 15 hours of negotiations. Is labeled a loan, but everyone knows it will not be repaid. In reality, this looks like a payday loan backed by Russian reserves as collateral. A broken system trying to raise more money rarely ends well. And this one is already running out of room to maneuver. But here is where the plan already starts to crack. Only 24 out of the 27 members of the European Union are participating in this joint borrowing. That alone tells you something important. Unity is already slipping. Some countries are quietly saying no because they do not want to drag their own economies into deeper trouble. And once you look closely at how this loan actually works, the situation becomes even more revealing. On paper, this looks like a loan to Ukraine. In reality, it is a blank check. The Council has effectively given Ukraine full access to the money, while Russia is positioned as the party expected to foot the bill. That is the structure. Once the money lands in Kyiv, the political incentive inside Europe to go after Russian assets increases dramatically. Because at that point, who is truly backing the loan? Is not some abstract institution. Is the European taxpayer. Is households and businesses that will see borrowing costs rise. This part is crucial. The 90 billion euros will be disbursed in 2026 and 2027. Ukraine is only expected to repay the loan if Russia pays reparations. That is the condition. And now you can see the trap Europe has built for itself. The loan structure quietly dictates the outcome of the war. Whether Russia wins or loses no longer matters. Reparations are assumed. If they do not materialize, the frozen Russian assets become the collateral. From Moscow's perspective, these terms are completely unacceptable. And it also puts the United States in a difficult position because any peace framework built around compromise has just been torched. Europe's grip on Russian money has tightened into something closer to a vice. But the real damage does not stop at geopolitics. It hits the real economy. Every euro sent to Ukraine comes from somewhere. It comes out of European industry, investment, and domestic growth. Bond yields across Europe are already near record levels. It almost feels like the warnings from the European Central Bank never even happened. From Italy to Germany to France, borrowing costs are climbing fast. Now ask the uncomfortable question. How is Europe supposed to compete with China under these conditions? China has scale, state coordination, and lower financing costs. The United States still has a longer runway because of the dollar's reserve status. Europe has neither advantage. As costs rise, European companies feel the squeeze first. Semiconductor firms, automakers, heavy industry. This 90 billion hole has consequences. In the short term, it crushes critical sectors. In the long term, it forces Europe back to the Russian assets question again because there will be no other funding escape hatch. This is why some EU leaders are starting to panic. We have said this many times. Europe eventually has to negotiate its own arrangement with Russia. Not for ideology, for survival. If you cannot survive the next few years, long-term plans mean nothing. EU industry will not hold on indefinitely under these pressures. And here is another uncomfortable reality. Europe used to be a major exporter. Today, it is deeply dependent on imports because producing domestically has become too expensive. The EU trade deficit with China has exploded. It went from around $150 billion before the pandemic to nearly $300 billion last year. In 2025, it is expected to get worse. That means European capital is flowing outward. Savings, profits, and demand are being redirected to China. And when capital leaves, innovation dies. Research and development dries up. Europe is effectively funding Chinese innovation with its own money. Ask yourself honestly, have you heard of a European AI model making global waves? Name one. That silence tells you exactly where this is heading. Russian commodities have to return to the system. Cheap energy has to come back. Trade with Russia has to be re-established. The longer Europe delays this, the further it falls behind both Washington and Beijing. Even Emmanuel Macron is beginning to acknowledge this reality. He wants Europe to reach out to Vladimir Putin over Ukraine. But here is the core problem. Why would Moscow listen while its assets remain frozen? Until Europe drops the seizure and returns the money, there's no incentive for Russia to negotiate seriously. That means the war drags on, and 300 billion will not stretch as far as Europe thinks. It will not last 2 years at this pace. In the bigger picture, asset confiscation brands Europe and the West as high-risk destinations for capital. Even inside the US, some policymakers recognize this. The only realistic way to use the money is with Russian consent through a peace framework. Anything else invites retaliation. Confiscating sovereign assets from a country you are not formally at war with is legally dangerous. It undermines the very rules-based order Western leaders claim to defend. The Kremlin will use this as proof that the rules only apply when convenient. In a multipolar world, neither Washington nor Europe can act without consequences. Over time, capital will continue to leave the West. And once trust is broken, it does not come back quickly. Sometimes it does not come back at all. This is why many believe the US will eventually distance itself from the seizure and let Europe absorb the fallout alone. With this 90 billion loan, Europe has crossed a line. There is no easy reversal now. So the real questions are these. Will Russia move in and seize European banking assets? And will Europe ever back down from this path? Drop your thoughts in the comments. Hit like if this helped clarify what is really happening. And subscribe if you want to keep navigating these shifts together, because this story is far from over.